Hi there, welcome to Kneppy Invest. What was the worst performing company on the AISC on January the 27th? You'd be right if you said or answered with Calidus Resources, share price down 25% on the back of the company releasing their quarterly report for the second quarter of financial year 23. There was something within this report that the market did not like, and that's what I'm going to discuss in today's video. Calidus came onto my radar about 6 months ago on the 2nd of August 2022 when they released this particular presentation to the market, talking about some of the numbers when their mine gets into production. And the main number I look at, apart from initial mine life, ore reserves, mineral resources, and expected average production, is all-in sustaining costs. This is probably one of the most important numbers when it comes to a mining company, because how much they sell their commodity for, they have no say or very little say unless they hedge it. But how much they spend to get the commodity out of the ground, they have a much larger say. Not a complete say, but a much larger say. So what I am particularly looking for are those mining companies in production that are spending less than most of the other miners. So for gold companies, I'm looking at all-in sustaining costs just above $1,000 per ounce, Australian dollars per ounce, which is very important because some companies report in American dollars. For example, one of the best or lower cost producing gold companies is Capricorn, and they spend $1,166 when it comes to all-in sustaining costs. And I do actually have a list of all the gold mining companies from highest cost producing to lowest cost producing. One of the highest ones is a company called Navarre, Navare, and they spend about $3,500. Cascoin, $3,135. Northern Star, $1,746. So in my opinion, it's very important to know how much the company spends to get the commodity out of the ground. And for Calidus, they were aiming for about 1,290 Australian dollars per ounce to get the gold out of the ground. And that's actually pretty good numbers. So I was very interested to see if they could hit that target. So because I am talking about it, it should give you a pretty good hint and understanding why the market punished Calidus. It has to do with the all-in sustaining costs that they have now changed when they're looking forward. So this is the December quarter report. Now, no cash flow just yet, but they have declared commercial production within the last month at Warrawoona, and they also declared or had a new gold discovery at Blue Spec. So their operations for the December 2022 quarter was 12,544 ounces. They also mentioned here steady state operations resulted in positive operating cash flow generation in the December month. Very important, they mentioned positive operating cash flow, not positive free cash flow, not profitability either. They just focused on positive operating cash flow. So I do think there is a potential here that the company was actually negative free cash flow and not profitable. But in their guidance, and this is the reason why I do think the market punished Calidus, is their all-in sustaining cost has been increased from 1,200 or just above 1,200 to now between $2,000 and $2,250 per ounce. They've also announced that they expect in the second half of financial year 23 a production of between 31,000 and 36,000 ounces of gold. Now, in saying that, there is also the potential that all-in sustaining costs, I always have a hard time saying that, could be initially high and then decrease over the next few years as they get further into their mine life. So there's definitely that possibility. And if that actually happens, and the AISC gets down to 1,250 Australian dollars per ounce, this company could be producing a lot of cash flow over the next few years. But the market is very short-sighted, and they saw that all-in sustaining costs for the second half of the year, and that was a little bit higher than they expected, and that's why the share price was punished 25% on January 27th, and it was actually down 31% in the week. Now, this is Calidus chart, weekly chart, since they listed on the ASX back in 2017. So 6 years of history right here. And the share price is moving towards the all-time low for this company, which is just below 20 cents. And twice in the past has the share price for this company reached that all-time low. When the company first listed in that first week, and also during the COVID-19 financial panic back in March 2020, the share price fell below 20 cents for a very brief period of time. Right now, the share price is at 29 cents. It wasn't that long ago, back in April of last year, when the share price reached a high of $1.07. So the share price of this company is well below that share price high. So maybe there is value for this company right now, particularly if the share price gets down to about 20 cents, there would be that support level for this company's shares. But I think the market wants to see if the company can bring down their costs, bring down their all-in sustaining costs. And if they can, I think there could be value for this company at current levels. That's all I have for this video looking at Calidus quarterly report for the second quarter of financial year 23. Share price down 25% because the market did not like that forward guidance of AISC, particularly because it was significantly higher than the guidance the company gave to the market back 6 months ago in August 2022. So if you have any questions about this company, any thoughts about Calidus, I'd love to hear them. So leave it in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.